Many people believe that wealth begins with numbers, charts, and perfect decisions, but the truth is far more uncomfortable. Wealth starts with a conversation you have alone, late at night, when you finally admit that no one is coming to save you financially. The moment you realize your future depends more on your habits than on your income. It is a private moment of honesty where you see the gap between the life you want and the decisions you've been making. And that gap is where the real transformation begins. For beginners and even for those who already know the fundamentals of investing, the hardest part isn't choosing an asset class or calculating returns. It's understanding that time is either your greatest ally or your greatest enemy. A person who starts at 20 doesn't win because they're smarter. They win because the calendar multiplies their money while they sleep. But even if you're past 30 or 40, the game is still winnable because the most important step is not timing the market, but finally deciding to enter it. The journey to financial independence doesn't begin with buying stocks, bonds, or real estate. It begins with the uncomfortable realization that your future lifestyle will be paid for by the person you are today. Every impulsive purchase, every ignored budget, every moment of "I'll start later" becomes a debt your future self must pay. And this quiet psychological pressure is what keeps millions trapped. But the opposite is also true. Every amount saved, every deliberate choice, every disciplined month becomes a silent gift to your future. Even small, safe investments compound into opportunities that today feel out of reach. And when you start to feel money working for you, not against you, everything changes. Because real freedom doesn't happen suddenly. It happens quietly, one consistent decision at a time. Starting from zero is not a problem. Staying at zero is. The modern world constantly pushes us toward instant gratification, encouraging us to spend before we think, consume before we reflect, and compare ourselves to lifestyles that aren't real. Under these pressures, saving money feels like swimming against the current. But the truth is that financial stability isn't about deprivation, it's about intention. It's about deciding that your long-term comfort matters more than short-term impulse. Many people avoid investing because they fear losing money. Ironically, the real loss comes from not investing at all. Inflation erodes savings, employers can change policies. Emergencies arrive without warning. The only true protection is building a financial foundation that grows independently from your labor. This is the essence of wealth for ordinary people, making your money work, even when you're not. Still, the journey isn't purely mathematical. It is deeply emotional. Money touches fear, hope, identity, self-worth, and even shame. Some people grew up watching financial chaos and now panic at the idea of risk. Others watched their parents sacrifice everything and now feel guilty saving for themselves. Understanding these emotional forces is essential, because behavior, not knowledge, is what builds or destroys wealth. The goal of this video is not to turn you into a financial expert. It's to give you a clear, grounded sequence of decisions that can guide you from confusion to clarity, from anxiety to control. Whether you're 20 or 40, whether you earn little or a lot, the rules of wealth building remain the same. Stability first, safety second, consistency always. And once the foundation is secure, you can begin not just investing money, but investing in the life you truly want to live. Building wealth begins long before the first investment is made. It begins with a mental shift, a moment when you accept that your financial future is not determined by luck or income alone, but by behavior, structure, and consistency. You may have heard that starting early is the secret, and yes, time is a miraculous force. A 20-year-old has decades of compound interest working quietly on their behalf. But the truth that most people avoid is that starting right is even more important than starting young. Because even someone at 35, 40, or older can build a strong financial future when they choose stability over chaos, clarity over impulse, and discipline over distraction. And while the young have time, the older have something equally powerful: urgency, maturity, and emotional understanding. The first psychological barrier most people face is the belief that they don't earn enough to save. This is almost never true. The real problem is that money leaks away through unexamined habits, small, repeated decisions made in moments of stress or boredom. The daily coffee that feels insignificant. The spontaneous purchase meant to numb anxiety. The night out justified by "I deserve it after this week." All of these form a pattern that stops wealth before it can grow. Here's the truth. Saving money is less about restricting pleasure and more about building self-respect. When you save, you tell yourself your future matters. You reinforce the identity of someone capable, intentional, and in control. Saving is a psychological pivot, not a punishment. Once you cross that mental threshold, the next step is building a secure financial foundation. This is where beginners often want to jump into investments immediately, seeking excitement or quick results. But wealth built on excitement collapses just as fast. Before anything else, you need an emergency fund. 3 to 6 months of essential expenses, stored safely in a high-yield savings account or an easily redeemable fixed-income option. This fund protects you from panic, prevents you from selling investments at the wrong time, and gives you the emotional security to invest with confidence instead of fear. Without it, every financial decision becomes reactive instead of strategic. After the emergency fund, the next stage is learning the basics of safe investing fixed-income products. These include government bonds, treasury bills, high-quality corporate bonds, certificates of deposit, or equivalents available in your country. Many beginners underestimate fixed income because it seems boring or slow. But boring is exactly what builds stability. Boring is what keeps you safe during market downturns. Boring is what gives you consistent returns while you learn the psychological side of investing. And for someone starting from zero, nothing is more powerful than safety combined with consistency. Fixed income is not the end of the journey, but it is the foundation on which everything else stands. Still, the emotional challenge is real. Some people fear risk so deeply they never move beyond fixed income. Others fear missing out and rush into high-volatility assets too soon. The correct path is balance. As you grow comfortable, you gradually diversify. You add index funds or ETFs that represent entire markets, not individual stocks, because diversification protects you from catastrophic loss. One single stock can collapse. An entire index will not. This is how you avoid the trap of putting all your eggs in one basket. Diversification is not advice for the rich. It is a survival strategy for the everyday investor. But here is the deeper truth. The foundation of wealth is not built with financial tools alone. It's built through identity, through seeing yourself as someone who will remain consistent for decades. Someone who makes calm decisions when the world panics. Someone who continues investing even when the results are slow or invisible. That identity shift is worth more than any short-term return. Your habits will build your wealth long before your investments do, and this is where starting early truly matters. Not because a 20-year-old is smarter, but because they have more time to make mistakes, correct them, and develop the emotional maturity necessary to stay invested through fear, uncertainty, market crashes, and life transitions. But even if you start later, the path is the same. Build the foundation, master your behavior, protect your money, and let time not luck carry you forward. Once the basics are secure, the journey enters a new stage, expanding your investments, diversifying safely, and understanding the psychology that separates those who build lasting wealth from those who lose everything when fear or greed takes over. After building your foundation, the next challenge is constructing a strategy that not only grows your wealth, but protects it from unpredictability. Markets will rise and fall. Economies will shift. Personal circumstances change. The investors who survive and prosper are not the ones who chase the highest returns, but those who build systems around safety, diversification, and emotional intelligence. This chapter is about that evolution, the moment when you stop reacting to money and begin directing it with purpose. For beginners and advanced investors alike, the safest starting point remains fixed income assets. They provide stability and predictable returns. But as your financial confidence grows, you add layers. The next logical step is low-cost, diversified index funds or ETFs. These funds contain hundreds or thousands of companies distributing risk across sectors and regions. Instead of gambling on a single stock, you own a slice of the global economy. This is the essence of intelligent diversification, spreading risk so no single failure can harm your long-term plan. Even professionals rarely outperform broad market indexes consistently, and the reason is simple emotion. They panic. They overreact. They chase trends. Index investing removes the illusion of control and replaces it with statistical strength. But diversification is not limited to equities. It includes splitting your investments across different asset classes, fixed income for stability, equities for growth, real estate for protection against inflation, and possibly even small, controlled exposures to commodities or alternative assets. Each asset behaves differently depending on the economic environment. When stocks fall, bonds may hold or rise. When inflation increases, real estate often strengthens. This variety creates resilience, a portfolio designed not just to grow, but to endure. Still, strategies alone are not enough. The true challenge is psychological. Most people lose money not because they chose the wrong investment, but because they couldn't control their emotions. Fear pushes people to sell when markets crash. Greed makes them buy too much when markets rise. Impatience leads to abandoning long-term plans for short-term excitement. And self-doubt convinces them they're always one step behind others. To invest successfully over decades, you must resist these emotional traps and replace them with disciplined habits. One such habit is automation, setting your investments to occur monthly without relying on motivation or willpower. Automation removes emotion from the process. You invest the same amount whether the market is up or down, building wealth quietly over time. This strategy, known as dollar-cost averaging, protects you from bad timing and ensures consistency. Another essential habit is reviewing your plan, not your emotions. Instead of checking your investment balance every day, you review your strategy every 6 months or year, adjusting only when needed. This protects you from impulsive decisions driven by fear or noise. But perhaps the most important psychological shift is understanding your purpose. Why are you investing? What does financial freedom actually mean to you? For many, it is not about luxury or extraordinary wealth. It's about stability, dignity, and choice. It's the ability to leave a toxic job, care for aging parents, support children, or retire without fear. When you invest with a clear purpose, spending becomes wiser, saving becomes meaningful, and discipline becomes natural rather than forced. You stop seeing investing as a sacrifice and start seeing it as an act of responsibility and self-respect. Many fear that saving money means giving up the pleasures of life, becoming stingy or deprived. But real wealth doesn't ask you to live like a monk. It asks you to choose what truly matters. The difference between a financially secure person and a financially lost one is not income, but intention. One spends to avoid emotions. The other spends to build a life. One buys escape, the other buys freedom. The key is balance. Enjoy today, but never at the cost of destroying tomorrow. And remember, your money is always working for someone. Either it works for you through investments or it works for the bank when you stay in debt. Every dollar saved, every investment made, every debt avoided is a shift in power. You move from being controlled by money to becoming the one who controls it. And as the years pass, this power compounds quietly, just like interest. Until one day you look back and realize you built something extraordinary not through luck, but through consistency and clarity. At the end of this journey, one truth remains clear. Financial freedom is not an accident. It is a consequence of choosing long-term meaning over short-term impulse, clarity over chaos, and consistency over excitement. Whether you start at 20, 30, or 40, the path is the same. Build a foundation, invest safely, diversify intelligently, and protect yourself from the emotional traps that destroy most investors. The years will pass regardless of what you do. The question is whether they pass in your favor or against you. Saving is not deprivation, it is preparation. Investing is not risk. It is responsibility, and wealth is not reserved for the lucky. It is built by the intentional. If you honor these principles, if you stay steady during uncertainty and patient during slow growth, your future self will live with a peace that few ever experience. Freedom is not bought, it is built. And starting today is the first brick in a life where money works for you, not the other way around.